Welcome to Quant Solutions. In today's explainer, we are diving deep into a really powerful investment philosophy. It's one that doesn't just, survive chaos. It actually thrives on it. We're going to talk about how to become an anti-fragile investor. So let's start with this question right here. What if all that market chaos, all that volatility everyone is so scared of, could actually make you stronger? Forget just weathering the storm. We're about to unpack a strategy that's designed to literally harness the storm's energy and use it to your advantage. It is a complete 180 from how most people are taught to think about risk. Okay, so let's get into it. To really get this strategy, we first have to completely redefine our relationship with uncertainty. Traditional finance basically gives you two options: be fragile or be robust. But there's a third way, a state that's way, way more powerful. Right, so on one end of the spectrum, you've got the fragile. The perfect example is a glass cup. It absolutely hates volatility. One little shock, you drop it on the floor, and poof, it shatters. But on the total opposite end is the antifragile. Think about the mythical Hydra. You cut off one of its heads, and two more grow back in its place. It doesn't just endure stress, it gets stronger from it. The whole goal here isn't to be a rock that just withstands a hit, it's to be the system that actually benefits from that hit. So, how in the world do we apply this crazy idea to a portfolio? Well, it requires a totally different set of mental tools. There are three core concepts that are really the bedrock of this entire philosophy. First up, and this is the big one, is convexity. This is really the mathematical heart of being anti-fragile. All it means is that you're in a position where your potential gains are just massively, massively larger than your potential losses. The best analogy? Think of it like buying a lottery ticket. Your downside is totally fixed. It's just the cost of that ticket. But your potential upside is, well, it's explosive. It's practically uncapped. Next up is the Barbell Strategy. This is the practical structure for how you build your portfolio. Instead of, diversifying across a whole bunch of medium risk stuff, you do the opposite. You polarize your portfolio. You combine two complete extremes. The huge majority of your money is in something hyper safe, and then just a tiny little piece is in something hyper risky and convex. And the final piece of the puzzle is via negativa. It sounds fancy, but it's just a simple idea: improvement by subtraction. The thinking here is that you gain a lot more by removing the things that can cause a catastrophic failure than you do by trying to add the next big winner. So the focus completely shifts from picking stocks to just ruthlessly getting rid of anything that makes you fragile. All right, so let's see how these concepts actually come together to build a real portfolio. How do you actually construct something that puts this whole anti-fragile idea into practice? Now, what's so interesting about this is just how stark and radically simple it is. You're looking at a 90-10 split. That's it. 90%, the vast majority of your capital, is just parked in extreme safety, where it's protected from being wiped out. Only that tiny 10% sliver is exposed to those high-risk, high-reward convex bets. So what goes where? Well, that big 90% safety bucket is super simple. It's cash or short-term government bills. Its only job is not to lose money. That's it. It's not there to make you rich. Now, the little 10% risk bucket, that's where all the fun happens. That's where the convexity lives. We're talking about things like cheap, out-of-the-money options, puts on the S&P 500 for crash insurance, or maybe calls on assets like gold and Bitcoin that can just explode during a crisis. And this, right here, is a brilliant illustration of via negativa in action. See, the power of this barbell strategy comes just as much from what you don't own as from what you do. You actively avoid that whole mediocre middle ground. That means no leveraged ETFs, no so-called moderate risk stocks, and absolutely positively no strategies that involve selling options for income. These things might seem safe, but they are secretly the most fragile assets of all. Avoiding that middle ground brings us to what this philosophy considers the single biggest mistake an investor can make, the one move that is the absolute definition of pure fragility. This quote from Taleb just captures it perfectly. Any strategy that involves selling options is like picking up nickels in front of a steamroller. You make these small, consistent gains day after day, week after week, and you feel like a genius, right? But the whole time, you are completely exposed to a single catastrophic event that can and will wipe out years of those profits in an instant. And believe me, this is not just some theory. History is absolutely littered with the victims of that steamroller. From the collapse of long-term capital management back in '98 to the Volmageddon event in 2018 and the Archegos failure in 2020, we see the exact same pattern again and again. Strategies that are short volatility work perfectly, right up until the moment they spectacularly blow up. So the crucial takeaway is this. The cardinal sin of investing, the most fragile position you can ever possibly take, is being short volatility. It exposes you to basically unlimited downside for a very limited capped upside. It is the exact polar opposite of the convexity that we are trying to find. Okay, so let's get into some concrete examples. What does an anti-fragile trade actually look like when you sit down to put it on? The trades themselves are surprisingly straightforward. You can buy deep out-of-the-money puts on the SPX, which is basically disaster insurance for the whole market. Or maybe you buy puts on a few specific super overvalued mega-cap stocks as a hedge against a bubble popping in one area. Or you could buy out-of-the-money calls on something like gold or Bitcoin, which is really a form of protection against currency debasement and a failure of the system. And the implementation is super systematic. You are not trying to time the market here. First, you set an annual budget, let's say 1 to 3% of your total capital, that you're willing to spend on these option premiums. Second, you buy them in pieces, in tranches, spreading them across different strike prices and expiration dates. And third, and this is key, you actively buy more when markets are calm and volatility is low, because that is literally when this insurance is on sale. But look, executing the trades, that's the easy part. That brings us to the final, and by far the most difficult aspect of this whole strategy, the mental game, the psychology of it all. Your performance profile is going to look totally alien to most investors. You will have these long periods, maybe even years, where you're just experiencing these small, nagging losses as your option premiums decay. You're going to look foolish while the market just melts up without you. Then, one day, out of nowhere, a crisis hits. And that tiny 10% slice of your portfolio can produce an absolutely extraordinary portfolio-saving gain. So, here's the bottom line. This strategy isn't about maximizing your returns every single year. It's not about being right often. It is about intentionally underperforming most of the time so that you can survive and then massively outperform when everyone else is getting completely wiped out. It's a strategy built for survival and prosperity in a world that deep down, you just cannot predict. And that really leaves us with a final question for you to think about. This isn't just a financial strategy. It is a true test of your psychological fortitude. Do you have the discipline, the stomach, to look wrong for months, even years on end, all while knowing that you are positioned to be right when it truly, truly counts? That right there is the core of what it means to be an anti-fragile investor.